Welcome to Skytech-Lens, October 2025. Toronto's real estate empire is in freefall. The city's trillion-dollar housing market has lost a quarter of its value, an unprecedented collapse, eclipsing even the 1990s bust. Bidding wars and sold-over asking signs have vanished, replaced by anxious silence and grim economic forecasts. For years, families and investors believed Toronto real estate was a guaranteed path to wealth, fueled by cheap credit and relentless demand. Now, the market's foundation has crumbled under the weight of soaring interest rates, leaving financial devastation in its wake. Active listings have surged to nearly 29,400, but buyers are scarce. Only 1 in 3 homes finds a buyer. The belief in real estate as a safe haven is shattered. 63% of Ontarians now see housing as a high-risk investment, a dramatic reversal from just 3 years ago. This crisis of confidence is fueling a vicious cycle of falling prices and panicked selling, as fear replaces the exuberance that once defined Toronto's housing market. To understand Toronto's collapse, rewind to the era of easy money. After the pandemic, the Bank of Canada slashed rates to near zero, unleashing a flood of cheap credit and igniting a speculative frenzy. Mortgage rates around 2% encourage buyers to take on massive debts, while government policies like the More Homes Built Faster program fueled rapid speculative development. Investors, not end users, snapped up condos, driving prices far beyond local incomes and turning homes into chips in a high-stakes casino. Urban planner Sharice Berta put it bluntly, "We built too many investor condos and not enough homes for people who actually live here." When the Bank of Canada hiked rates to tame inflation, mortgage rates tripled and the bubble burst. Suddenly, borrowing became punitive, affordability vanished and the speculative logic collapsed. The market, built on cheap debt, couldn't withstand the pressure. The great unwinding began. Nowhere is the pain more visible than in Toronto's condo sector. The glass towers that once symbolized prosperity are now monuments to financial distress. Downtown condo prices have crashed by 40% per square foot, wiping out hundreds of thousands in equity for owners. Investors, who bought at the peak, now face staggering losses and negative cash flow. Construction has ground to a halt. Housing starts are down 44%, condo starts down 60%, the lowest in decades. Developer insolvencies are mounting, leaving thousands of pre-construction buyers in limbo and high-profile projects abandoned. Deposits are tied up in legal battles, and many units may never be built. For countless Torontonians, the vertical dream has collapsed into a nightmare of debt and uncertainty. Behind the numbers lies a human crisis. Families who stretched to buy at the peak now face unaffordable mortgages and evaporating savings. For sale signs multiply as distressed sales force families to uproot, severing community ties and disrupting children's lives. Young buyers are trapped in negative equity, unable to sell without incurring catastrophic debt. The psychological toll is immense. A generation feels betrayed by a system that promised security. The rental market offers no refuge. Rents remain 18% above pre-pandemic levels, pushing former owners into an unaffordable rental squeeze. Institutional investors weather the storm, while ordinary families are squeezed from both sides. The result: growing instability, inequality, and pervasive stress. Secure shelter, once a given, is now a source of anxiety for thousands. Beneath the surface, a mortgage renewal time bomb ticks. Homeowners who locked in ultra-low rates must now renew at 4 to 5.5%, facing payment shocks of hundreds or thousands more per month. Nearly 60% of Canadian mortgages renew by the end of 2026, exposing a massive cohort to higher costs. Families are forced to extend amortizations to 30 or 35 years, trading short-term relief for decades of extra debt and interest. Even a modest Bank of Canada rate cut offers little real relief. The payment shock is set to trigger a new wave of distressed sales and further price declines. Essentials like groceries and savings are sacrificed to keep up with mortgage payments. The financial shockwave is only beginning. The next chapter of the crisis is about to unfold. The housing collapse is rippling through the entire economy. Construction suppliers report business down 30–40% as projects halt and renovation budgets vanish, leading to mass layoffs. Real estate agents, mortgage brokers, and lawyers face a sharp drop in transactions. Many are leaving the industry. Banks are tightening credit, freezing loans, and starving the development pipeline, ensuring the supply crisis will persist. Economists warn Ontario's GDP growth could fall below 1% if the downturn continues. Homeowners, squeezed by higher payments, cut back on spending at local businesses, threatening Main Street's survival. The service economy built around the housing boom is unraveling. The collapse isn't just about property values, it's about the erosion of economic vitality across the region. Every sector, every community, is feeling the chill. Governments at all levels are under fire for their role in the crisis. Provincial policies like more homes built faster and the Greenbelt scandal are blamed for fueling speculation and instability. Toronto's $975 million plan for affordable rentals and missing middle housing is seen as too little, too late. Federal programs like the Housing Accelerator Fund are criticized as slow and unfocused, offering little immediate relief. Policymakers have long been caught between keeping homes affordable for buyers and protecting existing homeowners' wealth. Now, with the market in freefall, governments are scrambling to contain the damage, exposing the failure to create a coherent, long-term housing strategy. Is this a repeat of the 1990s crash? Not quite. Unlike the overbuilding of the 90s, today's crisis unfolds amid a severe housing shortage. Population growth far outpaces new construction. The CMHC warns that restoring affordability would require millions of new homes, a goal that seems impossible. Mortgage stress tests and a more diversified economy offer some resilience, suggesting a faster recovery than the 7-year slump of the past. But household debt is far higher now, making Canadians more vulnerable to interest rate shocks. Some analysts predict another 10–15% drop as the mortgage renewal crisis fuels forced sales. The structural shortage may help in the long run, but for now, unaffordable debt and shaken confidence dominate. Toronto's housing collapse is a harsh lesson in the dangers of treating homes as speculative assets. The crisis exposes the need for a national strategy that prioritizes stability and affordability over runaway prices. Solutions must include more non-market housing, tax reform to curb speculation, and better alignment of immigration with housing capacity. For individuals, the lesson is, clear over-leveraging is risky, and no asset is a sure bet. The cultural obsession with homeownership is fading, replaced by a more balanced view of renting and financial caution. The goal now is to rebuild a resilient, equitable housing market, where homes are for living, not gambling. The work must begin now. Thanks for watching. Subscribe to the channel for more updates.